There is a lot of excitement around the world about the investment opportunities being created by the transition away from fossil fuels to cleaner technologies. One such opportunity lies in metals, but the sector has had a challenging year so far in 2023. What might be the reasons for this, and when and how might we see the fortunes of this commodity sector becoming brighter again? We discuss all of this and much more with Max Layton, Managing Director and Head of EMEA Commodities Research at Citi. Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you are an investor or just want to learn more about the topic, this podcast is for you. I'm Mobeen Tahir, Director, Macroeconomic Research and Tactical Solutions at WisdomTree.
And I'm Nitesh Shah, Head of Commodities and Macroeconomic Research here at WisdomTree.
Before we begin, I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and in this episode, Citi, and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. So with that, to kick things off and bring Max Layton into the discussion today, I will pass it over to Nitesh.
Thank you very much, Mobeen, and a big welcome to Max. Thank you so much for joining us today and sharing some of your insights across the metal space and maybe into other commodities. It's a great pleasure to have you here on our show. So maybe let's start off, with talking a little bit about the precious metals sector. That's clearly the most exciting sector of the commodity markets at the moment, with a lot of geopolitical premium actually having driven both gold and silver recently. But gold has outpaced silver by quite some margin. Silver is starting to rise a little bit right now, but do you see that continuing?
Of course, yeah. And look, first of all, thanks for having me on the show, Nitesh, Mobeen. It's great to be here. Precious metals. So, I mean, we and our economists through the course of at least, the last quarter had been, if you wind back the clock 6 to 9 months, this is when we initially had thought US growth would have been slowing down. That has been pushed out until the middle of next year. And with that, the bullishness on precious has been pushed out. But of course, gold and silver have a good run, as you mentioned, on some of the geopolitical issues in the past few weeks. It's certainly become super topical with our clients. In terms of our view, in the short run, I think it's difficult to split gold and silver. I think on the 6 to 12 month view, we have, a much kind of stronger bullish view in terms of percentage upside on silver than gold. So, I'd certainly, we've got gold getting up to $2,150 over the next 6 to 12 months. It's already trading at, around 1980. So that's around about 10% upside. Contrast that with silver where, we're looking for $28 to $30 on silver. It's trading roughly $23, $22.50 to $23 an ounce. So in terms of percentage upside, 20 to 25% plus upside in silver on that 6 to 12 month view. So we certainly see silver outperforming gold on that horizon.
Wow. And is that mainly because you expect a cyclical recovery, more industrial demand, or is it just the sources of demand are changing?
Yeah, I mean, a big part of the view is that silver is expected to be levered to the US growth slowdown. So both gold and silver have been very resilient to the increase in US real rates, increase in US 2-year nominal rate, for example, over the last 12 months. If I take silver 12 months ago, at the lows, it was around $19. And, real rates, US nominals dramatically higher over the last 12 months, and yet silver's trading $3 higher. Similar kind of story, but not as stark as what's going on with silver. And why is silver trading a bit higher? Why is gold being so resilient relative to US real rates? It's a couple of reasons. I mean, one, you can point to the physical markets being relatively robust for precious metals in India and China. But in particular, you can look at the demand growth on the silver side from EVs and from solar panels. I don't think it's just about that. I think it's very much to me about, if you look at the developed market wealth and the asset price outlook for the bulk of that wealth, which is tied up in property and equities, you look at the outlook, and the risk skew has become increasingly skewed to the downside as rates have risen over the last 12 months. So investors, relatively wealthy individuals, are basically shifting some of their assets into gold over the last 12 months because they can see that the risk skew around their portfolio is pretty much heavily skewed to the downside. And the longer we kind of persist with these higher rates, the more likely it is that we get that recession, that downturn, the potential downturn in property prices, equity prices, and such like. So, this is a big reason why you have this disconnect between what real rates are doing and what precious metals are doing. It's because investment is not driven solely by real rates. It's driven by the portfolio allocation decisions of relatively wealthy people, and 2/3 of global wealth in the developed markets.
Yeah, and I guess is there a role that central banks are playing here as well on the gold side? So, there's tremendous demand for gold from emerging market central banks in particular at this point in time. Is that helping gold a lot more relative to silver at this point in time, and maybe that could change later on as silver makes a catch up?
That has certainly been a bullish factor in the physical market, at least up until recently, and it's certainly an important narrative for investors in the gold space, alongside the de-dollarization narrative, which is kind of hand in hand with that, in some countries at least. And my issue with that is while that's been true in the past, it's very difficult to predict the deltas in that on a 6-12 month view. Let's say you feel fairly confident that the demand will remain robust, but will it remain as robust as it was in the last 12 months? I think that's really tough to call as an analyst. But look, it's certainly an important narrative. It's certainly supported gold over the last 12 months.
Yeah. So you mentioned both photovoltaics and just electrification in general being strong drivers of demand for silver. Has that surprised you on the upside or the downside? And do you think there's a lot more, is there a lot more exponential growth left in this?
Sure. Yeah, so the next couple of years, I mean, certainly, it's obviously more relevant for silver than for gold. The next couple of years, we've got silver demand coming from the photovoltaics and autos sector overall, picking up by, in the vicinity of 30 to 40 million ounces, which, in a billion ounce market is 3 to 4%, which is, I mean, it doesn't sound like a huge amount, but frankly, it's equal to the demand growth that's being driven by energy transition sectors in copper, and copper gets a lot of attention for that, and silver doesn't get very much attention at all. So it's equal to or greater than the contribution to demand growth in copper, and that's what we're seeing in silver going forward. Just for reference, I think we've upgraded our solar installation numbers in China at least 3 times and maybe 4 times in the last 6 months. China is rapidly accelerating its ability and willingness to install solar capacity domestically. And, we expect, I guess, the caveat here is we kind of present the energy transition demand as being structural, and it is over any kind of 1 to 5 year time period, in our view. But there might be a bit of a soft patch the next 6 to 9 months. We've talked about a bit of an air pocket considering there's some anecdotes about solar panel stockpiles, things like that. So it's possibly a little bit of a headwind over the next 6 to 9 months. That solar story, because the installation's been so strong, but we expect it to kind of roll back second half 24, 2025. Yeah, I mean, it's certainly supportive. Maybe a bit of an air pocket here, but look, overall, the silver view is all about US growth expectations, US 2-year nominal coming down. And I just make one point on that. It's like we've noticed and we've observed the last 12 to 15 months as for example, the US 2-year nominal rises, silver falls by a relatively small amount. And whenever the US 2-year nominal sells off a fraction, silver rallies really aggressively. And this has been true for the last 12 to 15 months. And so I actually think silver has a lot of convexity to the upside on a US growth rollover. And our economists think that US growth slowdown, as I mentioned, starts the middle of next year. I think what's been holding silver and to some degree gold back has been that obviously US growth has stayed pretty robust and unemployment relatively low. And at the same time, Europe has been deteriorating markedly. And so that's put upward pressure on the dollar euro and kind of keeping the gold silver trade and the bullishness at bay. You've got to think we're getting to the point where it's consensus and it's priced that Europe is going to underperform the US. And so from here, we're starting to think that the precious metals complex might trade the absolute slowdown in US growth rather than the relative slowdown compared to Europe. Because most people expect Europe to slow down more quickly and more aggressively than the US over the next 6 to 12 months. I would argue that's largely in the dollar, largely in the market, and largely in the precious metals complex. So now I think we're setting up to trade, more directly what is going to go on in absolute terms in terms of US growth over the next 6 to 12 months.
Wow, that's very interesting. That is great. And maybe we change gears a little bit. Let's talk a little bit about the base metal space. And obviously, we've just come away from the London Metal Exchange Week. I don't know. Tell us a little bit about the sentiment during the week. How was it? Was it strong? Were the conversations you're having surprising, or or were this similar to what you've seen in the past?
Sure, yeah, thanks. I mean, LME Week, I was certainly the busiest for years and years, like at least since 2017, 2018. We had people attending from, all over the world this year. And well, I thought it was a really enjoyable week. Like, I think people came away more bearish than when they came into the week. I think they entered the week bearish. If you go back, I mean, in my experience, LME Week sentiment, it starts with essentially, if you calculated the momentum on price across base metals and basically the change in prices over the prior 6 to 8 weeks, if it's down coming into LME Week, people come in bearish. They usually end the week bearish. In this case, prices have been grinding lower all year, or pretty much since April, and vol had been coming off since April. Been really tough trading environment for a lot of the investors, and they came in bearish. I think they left incrementally bearish, actually, and they left incrementally bearish in large part, I think, because you had Asian customers, corporates and institutional clients coming to Europe, and you had North American and South American clients, and generally speaking, the growth in those regions relative to Europe is okay. Like, basically, they came to Europe and they heard all the bearish anecdotes about Portuguese construction industry and German industrial complex and UK economy, and then they left more bearish. So I think that was a big part of it. And, positioning since then has come down significantly, right? So since LME Week, during LME Week, net speculative positioning across the complex has gone another leg lower. And, it's setting up for a difficult year end, I must say. I think, considering positioning is so low and considering President Xi is now starting to, look like he's highly focused on the economy, it's trickier right into year end. I mean, that doesn't mean to say there's not some amazing, I think, opportunities in metal, as base metals, industrial metals, battery metals over the next 12 to 24 months. I just think next couple of months is probably a little bit like what it has been over the last 6 months, which is a bit difficult, a bit choppy, grinding lower.
Max, I want to ask you about your view on copper, particularly. I've seen numerous articles published recently which quote you as saying something which I found quite interesting. And I'm mentioning the quote here that the coming copper boom will make oil's historic price surge in 2008 look like child's play. Now, it's a fascinating analogy, especially given it's been made against a fossil fuel. But I'm keen to hear your reasoning behind making it.
Yeah. Thanks for the question. So yeah, look, I think if you look at the copper to oil price ratio, copper has roughly, ballpark, it's traded at around 100-to-1 ratio to oil. So you can think about, let's call it late 2007, early 2008 oil at $80 as being roughly equivalent to $8,000 copper, roughly where we are today. And you can think about where oil got to, $150 by mid 2008 as $15,000. So in that context, we can start to kind of think about analogies from the first half of 2008 and compare them to what might happen to copper over the next couple of years. So I think copper basically has everything that oil had in the first half 2008, and I'll go through what I mean by that in a minute, but it has everything and some. And in a way, the reason why I use make it look like child's play is because 15,000 could well turn out to be highly conservative, actually, and I think it'll be clear when I spell out some of this stuff. But essentially, oil is a $3 trillion ballpark $3 trillion market, depending on the price. It obviously varies between like 2 and up to 4 trillion, but let's call it roughly a $3 trillion market in a $90 trillion global economy. So huge market. That's why it's so important to everyone. If you go and I obviously went and spoke with all of the industry experts that were around and really focusing on that market first half 08. Essentially, oil rally, the bulk of that rally happened in a pretty significant contango in a period that most people thought was a surplus market, and that the rally was generally attributed to some index fund buying, a little bit of speculative buying, and a little bit of a peak oil demand story. Now, if a $3 trillion physical market can go up on some index and speculative buying and a peak oil demand story, let's compare that to copper. Copper is like a $250 billion market, depending on the price. Right now, it's these prices, we're talking roughly a $200 billion market. So we're talking oil is a 15x bigger market. So we're talking dramatically smaller physical market. And then you look at the balances, so 2025, 2026, depending on exactly when we get the recovery in cyclical, some kind of even just a bottoming out in cyclical demand growth. And we don't think that's coming next year, but we do think it's coming 2025. So it is some way away. But if it happens in 2025, we're looking at a deficit in copper. A deficit in copper on our numbers that is equivalent to around a 4 million barrel a day deficit in oil, right? Which, for anyone who looking at the oil market, that's historically a massive deficit for the oil market. So first of all, just from a balance perspective, the balance difference between copper and oil is in the first half of 08 is stark, and suggests that copper could go up by more than what oil did in the first half of 08 because oil was in the surplus. Second thing is when you look at quantifying, like you look at trying to ballpark the amount of investor interest the amount of investor positioning, index fund buying, so most people think it was all about a story and index fund buying in the first half of 08. You look at copper, and copper is in our opinion, is the energy transition bull trade across the BCom, S&P, GSCI commodity complex. So it's got this unique set of factors, which means that, we're finding like based on, our client interest and the broadness of that interest, you've got energy people coming into metals because of the energy transition. Copper has this kind of unique set of characteristics that means that when they want to put on either an alpha trade exposed to energy transition, when they want to put on an ESG friendly trade within the commodities futures complex and options complex, when they want to find liquidity to be able to put that trade on, and or whether they want to put on a global recovery or fear of missing out of a global recovery trade, all of these things lead to copper. Basically, copper has this unique set that none of the other commodities have, and for that reason, I got to say the readership of our copper book, which we published 3 or 4 months ago, it was truly off the charts. Like, we publish a lot of stuff, and it's not all of it's read, but this one was well and truly read, and it reflects the interest in this space. Like, they're not reading it, in my opinion, because the copper price is going up, right? Obviously, copper had a tough 12 months, and vols come off, and they're not reading it because it just doubled and it's super topical. They're reading it because it has all these characteristics that means that when they're ready to believe the world isn't going to get worse economically, that's the first trade they're going to put on. And then when they're ready to, believe that their EV and renewable rollout is gathering pace, that's the first trade they'll put on. And then when they're ready to try and, shift the balance of their index funds towards more ESG friendly commodities, copper is going to get a significantly higher weight. So when I add up all of those investors, like, just stepping back from it, when I add up all those investors, you're talking about potentially up to double. So the previous maximum long position in copper on the LME and COMEX was about 2 million tons. It reached about 2 million tons. We think it can get up to about 4 million tons in 2025, 2026. So basically double the previous peak, right? And so we actually think you get dramatically more buying than what we saw in oil in the first half of 2008, in a dramatically smaller market, and in a dramatically tighter supply-demand balance than what we saw in the oil market. So from that perspective, 8 to 15 looks, eminently possible, and potentially, obviously, 15 is our bull case. Just for clarification, it's, our bull case scenario. Our average for 2025 forecast is 12,000, which is still up 50% from the current futures curve, and probably the best, the strongest projected return across any of the commodities we're looking at on that time horizon. But yeah, the bull case is 15, and from what I've just kind of laid out, I think you can see why that may even be conservative.
Wow. That does look like an amazing trade. I mean, I think you're right that copper has so many traits that other metals don't, and obviously the depth and liquidity is a key thing for a lot of investors. I mean, a lot of people talk about nickel as being something important to the transition, especially its use in batteries. But currently class 1 nickel, the higher grade stuff is probably more suitable for the battery value chain, which is undersupplied. But class 2 is massively oversupplied. There are technologies, I guess, that allow for conversion between class 2 to class 1. How do you see those progressing? And do you think that we're probably in the nickel world, that you potentially get an oversupply of the relevant material?
Yeah, thanks. I think this is actually already happening. Yeah, I mean, we're starting to just see it happen over the last few months, and the market as well as our forecast, our balances look like we're going to have material nickel class 1 surpluses over the next 12 to 24 months. And this is why we think the nickel price will be trading between 16 and 20,000. So we're sellers 20,000 plus, and we're buyers 16,000, roughly trading at 18,000. So we're bang in the middle there. Very short run, I think the nickel positioning is as stretched as any of the metals, and I think it's highly vulnerable to a short covering rally into year end. So, if you wanted to express what if President Xi eases policy, I think nickel gives you that leverage to that view. So, certainly it could rally to 20 to 22,000 in the next couple of months, either on China easing or some Indonesia supply risks that exist. But generally speaking, this class one surplus is going to weigh on the price and bring it back down after that, even if that does occur. And you have it coming back down to these kinds of levels over the next 6 to 12 months. So, I mean, the thing with nickel is it's a volume growth market. So we do see very strong demand growth from electric vehicles, for example, on a 1 to 5 year view. I think the tech is getting dramatically better on electric vehicles within China. And, we've had the view that it's going to make its way out of China one way or another. And I think this recent deal with Leap Motors and Stellantis is kind of a novel way of to see that happen. So as this kind of vehicles which to a large degree with the new batteries in China are overcoming range anxiety in the SUV, even truck category, as these batteries and cars make their way out of China over the next couple of years, I think we're going to have another really big increase in the penetration rates in SUVs and trucks, which kind of really is the part that hasn't been cracked because those vehicles just, the current batteries outside of China just aren't overcoming range anxiety. Anyway, that is to say that I think this EV story, while it's getting a bit of a knock at the moment over the next 6 months or so, it's going to come roaring back second half 24, 25, 26. And nickel will have very strong demand growth. And that will mean the volume of the market, the value of the market will be growing. And that means that, there will be producers out there who are growing volumes, who, you may be able to kind of make money by getting exposure to that. So I wouldn't say that, we see any price upside, but perhaps if you speak to my equity colleagues at Citi, then they'll be able to help you spot the nickel names that maybe can benefit from the volume growth in the market rather than the price.
Max, you've mentioned ESG as one of the motivations that commodity investors have and considerations that they might have, and of course certain commodities are relatively better than others on that particular criterion. But just taking copper's example, of course, based on the International Energy Agency's research, I was saying that you need almost 10 times more copper to generate the same amount of electricity from offshore wind than you do from, say, coal and natural gas. So the world clearly needs a lot more of these materials, whether it's copper or nickel or many others, to be able to decarbonize. But how do you square that conversation with your clients about the idea that to extract more of these materials, you need to mine more of these materials, and of course there is a price to pay for that, but you overall get a better outcome. So what are your ways to frame that discussion that for the greater good you do need more of these materials?
Yeah, I think what we've done is we've done some work where we've looked at from a GHG perspective, so from a climate change mitigation perspective, what does the metals industry as a whole, and we're including all the big direct emitters like steel, aluminium, into this discussion, what kind of net emissions might this space as a whole be generating if you give the metals industry credit for enabling EVs, carbon capture, and renewables, and if you give them credit on a GHG basis, they can essentially, more consumption of the metals going into the right areas based on current tech can basically drive us onto a net zero path. I mean, it's and also contribute to global growth and poverty alleviation, and importantly, a reduction in biodiversity loss associated with climate change, right? So from the global basis, it's fairly We published this work a couple of years ago, and so many different firms have run the ruler over it, and we've basically had no pushback. So I think it's fairly intuitive even for people that when you give the industry at the aggregate global level the credit for enabling these technologies to exist economically and to be rolled out globally, the electrification of the grid, for example, that those things are evident, but that's not to say that we take, like, I don't take make a judgment on on the relative importance of the global impacts versus the local impacts. And the local impacts, as you say, they're real. And the mining industry obviously needs to do its best to minimize those impacts. In terms of the scale of the impact and this idea that we might need dramatically more copper to get onto this net zero path, I actually think that at the right price, and copper isn't a $3 trillion market like oil. So, for example, a doubling in the copper price is a small share of global GDP. It doesn't necessarily drive huge greenflation alone. But if I run the models and I look at a doubling of the copper price, we are going to, on paper, we're going to get a very, very dramatic response in scrap recovery. Right. So there are ways that we can clear the copper market at the right price and have enough metal for the energy transition. If we just reclaim more from the scrap pool, for example, without throwing out our lamp, putting it in the bin, the tiny bit of copper in that cord gets reclaimed at the right price, for example. Or antique dealers globally, melt down some of the brass instead of trying to sell it as a kind of a relatively modern antique. I don't obviously want to recommend people melt down their ancient wares, but I think there is a pool that every year that comes back to the market in the vicinity of 14 million tons of scrap, and we're only reclaiming 4 million tons of that. Right, so there's a lot of room at the right price to rise up that scrap cost curve and kind of meet the energy transition demand. But you have to get the higher price, right? So that's kind of the reason we came up with 12,000. It's one of the reasons. One is because maybe the SRB maybe starts to talk about selling at that level. But the other big reason is because at that level, we get a lot more scrap and that balances the market.
Wow, that is truly fascinating. I mean, that's, as you say, there's clearly when you look at the full value chain, there's a lot of merit to shifting the materials, and it may not impact our lives as much as people expect. I guess another big material in this energy transition is lithium, and obviously lithium has had a tough time this year. It's fallen by quite some margin, but where do you think lithium prices could go going forward? I mean, it's a relatively small market at the moment. I think we all expect it to get bigger, but tell us a little bit about some of the dynamics of the market growing and whether the price can also rise as the market grows.
Yeah, this is a great market. I've got to say, as an analyst, I think I'm super excited to be involved in covering this particular market going forward. It has shown itself to have the potential to have extreme volatility. $5,000 3 or 4 years ago, up to $80,000, down to $20,000 in the start of the second quarter of this year, back to $40,000 by the end of the second quarter this year, and now back down to roughly $20,000 depending on the product. Super volatile market, super interesting to analyze because it has a couple of characteristics that are quite different to the other commodities that we look at. It is relatively difficult to store, certainly in hydroxide form, which is 90% of the consumption outside of China is in hydroxide form. It's difficult to store for more than 3 to 6 months. And on top of that, it's a market that's basically booming. It's been growing. It's going to grow on our numbers at least at 20% per annum every year through the end of the decade. And we don't kind of dare forecast beyond the end of the decade, but at least 20% per year beyond through the end of the decade. And that kind of growth compares copper at 3%, oil at practically nothing, coal at negative. I mean, this is an absolutely, but it's doubling in size every 3 to 4 years. So it's a booming market. And look, maybe I'll leave it there, but in terms of price forecast, we think it's it's down around the cost curve here, stay here around these levels for the next 6 to 12 months. And at some point, this is going to set us up potentially set us up for a pretty strong rebound. But at the moment, it's all about destock and restock cycles and oversupply. And, it's not great at the moment in terms of the physical balances, but I think that is going to help this market grow in terms of liquidity going forward. I think there's kind of a natural price level between 20 and 30,000 where the consumers and producers are going to be inclined to meet, and that will really help the liquidity on the exchanges and OTC over the next 12 months.
Max, of course, China is an important frontier in the lithium market, of course, particularly when we talk about lithium-ion battery manufacturing. And with US looking to reduce its dependence on China for all sorts of technologies in various supply chains, and US, of course, is a relatively small market in terms of the production of lithium itself. Do you see US being able to reduce its dependence there, and maybe the dynamics of the lithium supply chain changing in the coming years?
Yeah, US is, maybe the time horizon is important here, right? Because the next couple of years, there isn't a lot of supply coming on in the US, and it will be dependent on imports, whether it be of batteries or product or batteries or products on the lithium side. Looking out towards the end of the decade, though, there is the potential, and certainly we're modeling that on the kind of mine supply side, the US is nearly kind of independent, and basically raises its mine supply potentially quite dramatically to roughly equal what domestic consumption of lithium will be. Now, that doesn't mean that the US will have the conversion capacity on the mine supply, but at least in terms of the mine supply part of the chain, US, on our numbers, almost gets to self-sufficient by 2030.
Wow. So, Max, thank you so much for coming on to our show and sharing your insights across such a broad range of commodities with our audience. If our audience want to follow some of your research, how do they get hold of it? Where do they go to read your stuff?
Sure. So, I mean, they can, I think, get in touch with you and, get my email from you, or they can find me on LinkedIn, and, we'd be happy to, introduce them to the Citi sales team and on Citi's research.
Excellent. Thank you very much, Max. And I guess one closing question from me before you go. If you must pick your one favorite metal for the short term, say the next 6 months, and your one favorite metal for the medium term, let's say the next 3 years, what would you pick?
Yeah, so I'll take the second part first, which is clearly copper by some distance. At some point, I think lithium will set up for a potential doubling in price, similar to what we're forecasting in copper. But I think that's maybe you have to get the right circumstances. But look, copper is the medium term one. We're not really particularly bullish on any of the industrial metals over the next 6 months. So I'm going to actually maybe cheat a little bit and pick silver. So, we think silver up to $28 to $30 is the 6 to 12 month top pick.
Excellent. Well, thank you very much once again, Max, for your insights today. And thanks everyone for tuning in. We hope you've enjoyed this episode of the Commodity Exchange. If you want to hear more from us, please subscribe on whichever platform you're using, and please do take a moment to leave us a rating. You can follow us on LinkedIn or X at Nitesh Shah WT and at Mobeen Tahir WT. And if you want to learn more about commodities, visit WisdomTree's website, where we have a wide range of research materials and insights. Until next time, take care.